Hello, everyone. My name is NOVIANA aka RAHAYU, with NPM 2441146. What are accounts? Accounts are basic elements in accounting that are used to record transactions that occur within a company. Each account has a specific category and serves to monitor changes in assets, liabilities, equity, income, or expenses at a given time. These accounts will later be presented in financial statements to assist in decision-making. There are 5 types of accounts and their normal balances. The following is a more detailed explanation of each type of account and its normal balance. Assets. Assets are resources owned by a company that have economic value and can be used to support company operations. Assets include various types such as cash, inventory, accounts receivable, buildings, and equipment. Normal balance. Debit. Example. When a company receives cash, the cash asset account will increase on the debit side. If the company purchases equipment in cash, the equipment asset account will increase on the debit side, and cash will decrease on the credit side. Liabilities. A liability is a debt or obligation that a company must pay to another party in the future, usually as a result of a loan or purchase with delayed payments. Normal balance. Credit. Example. When a company takes a loan from a bank, the bank payable account, liability, increases on the credit side. If the company pays off part of the debt, the liability decreases on the debit side, and cash decreases on the credit side. Equity. Equity represents the owner's right to the company's assets after deducting liabilities. Equity is often referred to as capital. Normal balance. Credit. Example. If the owner injects additional capital, the capital account, equity, increases on the credit side. If the company incurs a loss, equity decreases on the debit side. Revenue. Revenue is the income earned by a company from its main operating activities, such as the sale of products or services. Normal balance. Credit. Example. When a company receives revenue from sales, the sales revenue account increases on the credit side, and cash or receivables increase on the debit side. Expense. Expenses are costs that a company incurs in order to generate revenue, such as rent, salaries, and utilities. Normal balance. Debit. Example. If the company pays for electricity costs, the electricity expense account, expense, increases on the debit side, while cash decreases on the credit side. Here are the detailed steps in recording transactions into a general journal. Identify the transaction. Make sure the type of transaction and the affected accounts are correctly identified. For example, if a company purchases equipment worth 5 million Indonesian rupiah in cash, then this transaction will affect the equipment. Asset and cash, asset, accounts. In the example above, equipment increases, asset, and is recorded in debit, while cash decreases, asset, and is recorded in credit. Perform recording in general journal. Recording format. Each journal entry generally includes the date, account name, debit and credit, and a description of the transaction. Debit and credit. Record the appropriate amount of money in the debit or credit column depending on the normal balance. The description is useful to explain the details of the transaction so that it can be easily understood in the future. For example, in the transaction above, the description can be written as January rent. Payment. Posting to the ledger. After the transactions are recorded in the general journal, the data is then transferred to the ledger according to the respective accounts for balance adjustment. The ledger records all the debits and credits that occur on each account, making it possible to see the final balance at the end of the accounting period. With these steps, the financial recording process will be more organized and systematic, so that financial statements can be prepared accurately.